What's going on, everybody, and welcome back to yet another video. In today's video, I'm going to be showing you how you can use fair value gaps to identify high probability trades, but then I'm also going to be showing you a real life example on a real live trade that I took using a fair value gap. That way you know what to look for when taking these trades. But real quick, as always, if you guys do find value in today's video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. But without further ado, let's hop into the video. All right, so before I show you guys the live trade example, I want to start off by showing you what a fair value gap is. So a fair value gap is going to be a 3-bar formation. Now we have bullish fair value gaps and we have bearish fair value gaps. So what we're going to start off with is bullish fair value gaps. So like I said, this is going to be a 3-bar formation. The first candle, we can put some little upper wicks and lower wicks on it, but we are going to have a decent first candle right here. It can be green, it can be red, it really does not matter. But what does matter is going to be the second candle right here. Now for this second candle, it needs to be a large and aggressive green candle to the upside. It cannot be red, it has to be green. And then finally for the third candle, again, it could be green or red, it does not matter. But what's important about the third candle is the low of the third candle, whether it be the body or the wick. We want to make sure that it does not intersect with the high or the low of that first candle, as we can see right here. If we were to get something like this, there is no fair value gap, also known as imbalances in the market. It has to be one candle right here, again, green or red. Second candle, very large and aggressive move up. Third candle, this lower wick or body cannot intersect with the first candle's upper wick or upper body. Now, if we get that then creates an imbalance in the market. Now, with this imbalance, what we are going to do is we are going to take a rectangle and we are going to plot it from this upper wick right here to the lower wick right here, or whichever point is the highest and lowest. Again, if the body was down here, then you would draw it to the body, or if the upper body was all the way up here, then you would take the body. But you're just taking the high of the first candle to the lowest point of the third candle. Now from here, essentially what we are looking for is for price to trade back down into this area, make it support with bullish confirmation, so a bullish wick, bullish candle, whatever, and an increase in volume to get long. You never want to go long just because price trades down into a bullish imbalance. You always want to look for confirmation before you take the trade. And again, when we get to the live trade example, I will show you exactly what I like to look for when we trade into these areas of imbalances. So this is exactly how a bullish imbalance is going to look on your chart. Now, as far as a bearish imbalance, it's going to be the same thing, but flipped upside down. So if we make all these candles red, again, the color of the first and third candle does not matter for the bearish imbalance. What's most important is the second candle has to be a large and aggressive move to the downside. So the second candle has to be red. Now for the third candle, what we need to make sure is that the upper wick or the body does not intersect with the low of the first candle. So again, if the wick were to come all the way up into here and intersect with it, then there's no imbalance. So as long as those two do not intersect, there is an imbalance in the market. So what you will do is you will take the lowest point of the first candle and take it to the highest point of the third candle. Now this is going to be your bearish imbalance within the market. So what we are looking for is for price to trade back up into this area. We're looking for bearish price action, bearish volume, long upper wicks to get short. Again, you do not want to go short just because price trades into the area of the imbalance. You always want to look for confirmation. Now, I do get asked all the time, what time frames do you plot these on? Personally, I plot them on the 5-minute or the 2-minute time frame. I know traders who like to use them on a 15, 30-minute, hour, 4-hour, etc. It's just the higher the time frame, the bigger the zone is going to be. And once we start getting into higher time frame analysis, that's when I rely more on supply and demand. I honestly do not plot these imbalances on anything higher than a 5-minute. So now as far as actually plotting these on the chart, let me show you guys some examples, and we can start off on this one today. This is going to be a bullish imbalance. As we can see, we have this first candle right here. Second candle is a very strong and aggressive move up. Third candle does not intersect with the high of the first candle. Therefore, this is going to be a bullish imbalance, and price never traded back down into it today. But had price traded back down into it and made this area support and I saw buyers, then I would have absolutely looked to get long. Or if we look at yesterday, we actually had a few. So here was a bullish imbalance. Here was another bullish imbalance. So again, that's just a couple examples on how you would plot them. Here's another bullish imbalance right here. I'm sure you guys get the point on how to plot the bullish imbalances. So now as far as a bearish imbalance, here's a really good example here. So we have this one candle right here, second candle, very large and aggressive move down. Third candle pops back up, never intersects with the first candle low. Therefore, here's our bearish imbalance. As we can see, we trade up into it, reject it, go back down. Here is another bearish imbalance. Again, very large move down. First and third candle do not intersect. Therefore, here is our imbalance in the market, and that's where we're looking for the market to reject to look to potentially get short. Now, if you want to increase the likelihood of price bouncing or rejecting off of an imbalance, you want to combine it with other zones as well. So Fibonacci retracements, pre-market highs, pre-market lows, VWAP, moving averages, whatever. The more confirmation that you have within that imbalance, the higher the probability that price is going to bounce or reject. Another thing to make note of, because sometimes there is a lot of imbalances that are created intraday, you always want to look at the most prominent imbalance. So the very first one is what you want to mark. So as we can see right here, we had two different imbalances, one there and one there. Well, what I would personally be watching, I wouldn't even plot this one up here. I would plot this very first one right here. Those tend to be the higher probability imbalances within the market. So like I said, for bullish imbalances, we're looking for a very large move to the upside on the second candle. Make sure the first and third candle don't intersect. Take your rectangle, plot it from the high of the first candle to the low of the third candle. That's going to create your imbalance. Vice versa, if you're looking at bearish imbalances, when price trades back into those areas, however, you want to be looking for other confirmations such as pre-market highs, Fibonacci retracements, VWAP, moving averages, whatever it may be, because those always set up for higher probability bounces or rejects within the imbalance. But another thing that I really like to use to understand are there actually buyers or sellers within that imbalance is going to be Bookmap. Now, I just dropped an entire video. It's like a 17-minute video on how to use order flow to confirm your trades. Highly suggest you guys go check that out. So I will be leaving that link down in the description. But now I want to show you guys how I was able to use an imbalance in the market and piece it together with another key level as well as order flow to identify a high probability trade. And I do want to say real quick, if you are looking to get funded, I live trade every single day here on YouTube and give my trades out for completely free. So if you want to get funded, pass your evals and work towards a payout, I will be leaving my affiliate link for Apex down in the description. Make sure you guys use discount code Brandon in all caps. That is going to get you the best possible discount on Apex. And like I said, I live stream every single day here on YouTube. So get your accounts, come tap in, let's get you funded, and let's get you some payouts. All right, so what we're watching, this is a trade that I took on June 9th. And what I was watching was for NQ to break above this pre-market high at 21824 and a pullback to get long. Now, what we are going to notice is as NQ broke above pre-market highs, it created this imbalance in the market. So we have that pre-market high, and then we have our imbalance from this high to this low right here. This is a setup that I really like to look for intraday. A breakout above pre-market highs or pre-market lows, and then we create that imbalance. What we are going to look for is for price to trade back either into the pre-market high or pre-market low with the imbalance to either get long or short. So now we can also see within the order flow, this is my imbalance area right here from about 21840 down to like 21825. Now, as price starts trading down into the imbalance, I want you guys to notice the buy orders that came in within the imbalance. So this set up for a very high probability zone, because we also have buyers down at pre-market lows, which are holding price up, but they're also within the imbalance, as well as that 5-minute 21 EMA. Again, the more confirmation that you have within this zone, the better off you are taking it. So as price dips down into this area, and I notice that we are getting the buyers down within the imbalance, as well as buyers down at pre-market lows. Again, make sure you guys check out the order flow video that I just put out. But what you're going to notice is as price dip down into the area, again, where the buyers are within the imbalance, we start to bounce. Now, as soon as we started to bounce, that is when I got long. Now, for this trade, I was able to capture 30 points. It's not a crazy trade, but that is $600 per contract on NQ. So again, we have this imbalance, we have the pre-market high, we have the 21 EMA, but the most important is that we actually and visually saw that we had buyers within the imbalance. So again, that set up for a very high probability trade, and I was able to capture this move up right here. But that is going to wrap up this video on how to use imbalances within the market, as well as using order flow to actually confirm that it's a valid imbalance. Again, I cannot say it enough. Go check out that order flow video that I dropped. That link is down in the description. If you guys did find value in today's video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. As always, everybody have an amazing rest of your day, and I'll see you guys in the next video.